Okay, let's get settled in.
Are they all around?
They're all around, so don't worry about it. So I'm not going to ask the two questions I've started every class with so far because I'm going to assume that you're part of a group by now and you picked a company. Okay? If you can, please go in and enter your company names and where you are in terms of number crunching in the Google shared spreadsheet. It's not for grading. I just want to get a sense of what companies you're picking. And don't freak out if you see somebody else picking the same company that you are. It's okay. It's okay. Now, and don't freak out if I happen to value your company that you happen to pick. Again, it's okay. Everything's going to be fine. Just pick your company, tell your story, value your company. Okay? So let's pick up where we left off on Wednesday. We were almost to the end of the cost of capital. We've talked about the cost of equity and the cost of debt, right? So I want you guys to get me up to speed. I've forgotten everything about cost of equity and cost of debt, so I'm going to ask you to fill me in on exactly how we go about estimating these two numbers. You want to be my first guinea pig? I'll help you out. To get a cost of equity for a company, what do I do? What's the first thing you need to do? When you sit down to come up with a discount rate, what's the first thing you need to do? Decide what currency you're going to do the valuation in, right? Before you do anything else, get that nailed down. Otherwise, it's going to come back and revisit you. Why do we need the currency nailed down first? Because to get the cost of equity, the first number I need is a risk-free rate. Excellent. That's good. A risk-free rate. And to get a risk-free rate, I can't get it without a currency. So I start with the risk-free rate. And what else do I need to get a cost of equity? Risk-free rate. What are the two other inputs?
Equity risk premium.
An equity risk premium, which I get by looking at what? Where the company does business, not where it's incorporated. I take weights. And some of you are already wrestling with the fact that your companies are not exactly forthcoming about their breakdown of revenues, right? Like somebody's saying, oh, what do I do? My company's breaking it down to the US and rest of the world. You got to work in the world you're in, not the world you wished you were in, with the data you have, not the data you wished you had. It's not like I have some magic insight into this company's breakdown. If that's all they give you, that's all you have, and you have to. And that's why I give you regional averages and the GDPs. Don't get too caught up in this and finessing it too much. If you're within shouting distance of a reasonable equity risk premium that reflects where your business is, we're okay. So you got a risk-free rate based on the currency you pick, the equity risk premium based on operations. Last number I need is a beta. What do I do to get that? I look at the businesses you're in and I see how I jump in, even though you so act like, make your mouth move. I'll kind of act like that's what you said. Right? I look at the businesses you're in and I take a weighted average, right? So if you're in 70% steel, 30% chemicals, I take a weighted average. I have my cost of equity. That took care of the cost of equity. Then I get to the cost of debt. Much easier process, right? We start with the same risk-free rate from which we start the cost of equity. Then what do we do next to get to a cost of debt? You come up with a measure of default risk, and you come up with a default spread based either on an actual rating or a made-up rating, but essentially your job becomes how much default risk. So that gives you cost of debt. And there's one final stop I have to make before I get the cost of debt, which is interest is tax deductible, so I've got to give you that tax benefit. I multiply by 1 minus the tax rate. I don't know whether I was explicit about what tax rate to use there. But what is the tax rate I should use to come up with my after-tax cost of debt? When we did cash flows, I said you could use effective tax rates, and we'll talk about different tax rates when we get to cash flows. But when I talk about cost of debt, what's the tax rate I should use? What are my choices? I could use the effective tax rate, which is an average tax rate you paid across all your income, or the marginal tax rate, which is the tax rate in your last dollar of income. And the numbers are going to be very different, as you're going to see for your company. The marginal tax rate for US companies is close to 40%. The effective tax rate for Apple is 26%. Which one do I use?
Marginal tax.
Why?
Because it's in the last dollar and the interest rate is accrued.
So let's be more explicit, because this is an argument you're going to have when you get to work, because there will be people in work say, let's use the effective tax rate. Interest saves you taxes at the margin. You're saying, what the hell are you talking about? You have $1 million in income. You have $100,000 in interest expenses. What do you report as taxable income? You take the million in income, you subtract out the 100,000, you report 900,000 in taxable income, right? Think of where you saved on taxes, not the first 100,000, not the middle 100,000, but the last 100,000. The marginal tax rate is the tax rate in your last dollar of income. And it's actually something to keep in mind. Companies decide where to borrow money. What does that mean? What did Apple's effective tax rate was? 26%, right? Why is it so low? Because they get a substantial amount of their income outside the US in places like Ireland. And they haven't brought the money back. That's why they have $150 billion in trapped cash. We'll talk about that too. So 26% of it. They've also got about $94 billion in debt. Guess where all that debt is parked? It's not in Ireland, it's not in China. Where do you get the biggest tax benefit from debt? The US with a 40% tax rate. Every single dollar of the 94 billion is parked in the US, and that is why the US has the most perverse tax code in the world. Because what does it do? It has this marginal tax rate that's high, so it encourages people to borrow money, and it's got a tax code that's so screwed up that they can never collect even close to the 40%. They collect something very similar to what Europeans are collecting. But Apple, so when I do Apple's cost of debt, guess what? I'm going to use the marginal tax rate for Apple. And we can say now we're in a year where we might have to debate what the marginal tax rate for the US might be by the end of the year. Because there is talk about changing the corporate tax code. And this time I think they're serious. I think whatever the new tax code form will take, the corporate tax rate is going to come down. The question is not whether, but how much. So by the end of this year, that 40% corporate tax rate you see as a marginal tax rate in the US could become 30 or 25 or even 15. Do you think that's going to have a big impact on your after-tax cost of debt? Debt that looked cheap at the start of this year, but the 40% tax rate is going to be more expensive. It's going to have huge ripple effects. But when you do your cost of debt, it's an after-tax cost of debt based on your marginal tax rate. Any questions on either the cost of equity or the cost of debt? So got those two numbers. What's the last step? To get a cost of capital, what do I need to attach to these two numbers? I need to attach weights, right? How much equity, how much debt? So let's talk a little bit about those. Oh, before I forgot the start of the class test. Let's do the start of the class test. I'm sorry, I should have done this first. Today we're going to talk about cash flows. Right? Very simple questions. You're valuing your company as of today. In fact, you'll be valuing it as of May, whenever the project is due, May 8th of 2017. You're not valuing it as of December 31st of 2016 because who cares what it was in December 31st? I want to know whether I should buy the stock the day you turn in your valuation. So you want your valuation to be as updated as you can get it, right? So when I ask you what the risk-free rate is, I don't want a risk-free rate as of December 2016 or December 2015. I want it as of May 8th, 2017. Or whenever you do your valuation, May 5th, May 3rd. So that you can update because it's a market number. When I ask you what the market price is, I want the market price as of May 3rd of 2017. That's not a problem. But when I ask you what the earnings for this company was or what the revenues for this company was, where does it come from? It comes from accounting statements, right? And accountants don't update every day. So on May 3rd, when you look at your company, or today when you look at your company and I say, what are the revenues and earnings? You're actually stuck with these accounting numbers that are going to be old. How old? It depends on what you're doing your valuation of. If any of you are valuing companies based on an annual report, and your company has a calendar year, I can almost guarantee you that that annual report is from 2015. You know how I can guarantee that? Because by the time the annual report comes out, it's going to be March or April. So if you're using an annual report using 2015 numbers, you're valuing a company as of February 2017, using 2015 numbers, that's asking for trouble, right? So you want to update the numbers. And in the US, there is a way to update it because US companies, in addition to reporting full annual reports, also have pretty full quarterly reports. So my question is, how do you get an updated revenue or earnings? And I'll give you some choices and you tell me whether this is a good idea. I could take the last quarterly report. I could take the last 10K, which would give me the old numbers. I could take the last quarterly report and multiply by 4. Right? Third quarter, it's one quarter's numbers. Can I multiply by 4? Is that okay? Why might that get me into trouble? Because of seasonality. You take a retail company, the fourth quarter looks very different from the third quarter. Multiplying the last quarter by 4 is a non-starter. Okay? I could add together the earnings over the last 4 quarters. You know what that's called? It's called a trailing 12-month data. I'm actually going to put up my tools webcast this week is how to create trailing 12-month data with one 10K and one 10Q, one annual report and one quarterly report if you don't have a US company. You don't need 4 quarterly reports. It's actually very straightforward to get one quarterly report and one annual report, combine them to get a trailing 12-month. That's what you should be doing as your base number. You could, of course, tempt fate by trying to use a forecasted number. Many people actually, if you look at right now, you have 3 quarters of numbers available for companies through September. There are analyst forecasts of what revenues and earnings were in the fourth quarter. The only problem is it's going to be bits and pieces. It's not going to be a full report. So the real choice is either trailing or this kind of forecasted number. Don't use the last annual report of the 10K for your valuation. If that's all you have, for the moment get started with it, but in April you might have to revisit your valuation. Do you see why? Because the new annual report will come out. Make sure you use the most updated numbers you can. Any questions? And for some of you, here's what might happen. Don't freak out. Remember I made you pick a money-losing company? You picked it based on... Sometime in the next 2 months, your money-losing company might become a money-making company. It's okay. I'm not going to punish you for saying, how come you didn't see this coming? It's okay. I'll still count it as a money-losing company. But you don't control those things. Your money-making companies might become money-losing companies. Your money-losing companies can become money-making companies. Today we're also going to face up to what I think is an accounting problem. I don't know whether you remember your first accounting class, but I do, vividly. I still remember how the accounting professor said accountants look at expenditures, and he said capital expenditures are any expenditures that create benefits over many years. That's how he described it. He didn't describe it as fixed assets or tangible. He said anytime you expend money expecting benefits over many years, you have a capital expenditure. So I'm going to go through a list of items, and you tell me based on this definition of CapEx, not the definition you might see in the accounting statements, but on this definition of CapEx, which is the generic definition, whether these are capital expenditures. Building a manufacturing plant for a manufacturing company. Sure, right? And will accountants also treat it as CapEx? Yeah, in this case, not only is common sense telling you it's CapEx, but if I look at the statement of cash flows, this will be called investment in property, plant, and equipment as a CapEx. How about R&D expenses for an Apple or a Google? First, let me ask you a question. When you're an Apple or a Google and you spend money on R&D, are you hoping for benefits this year? No, it's not going to happen. If you're lucky, it might happen over the next 10 years. So obviously it's a CapEx, right? You think, so what's the big deal? But what do accountants treat it as? It's an operating expense. And we're going to come back and talk about how we need to fix it. Because if you don't fix it, your valuations are going to be screwed up. Let me keep going. What if you're Coca-Cola and some of the advertising you're doing, how much money do you think Anheuser-Busch spent on that, on the Super Bowl ads, right? And some of that was designed to get you out there to buy a Bud Light today, but some of it was to build a brand name, right? So you could argue that some of those expenditures are really capital expenditures, but accountants, again, are going to treat all advertising expenses as operating expenses. Or what if you're a consulting firm like McKinsey or an investment bank like Goldman Sachs? Your biggest asset is human capital, right? You could actually argue that your recruiting and training expenses are really capital expenses. So you can already see that what accountants call CapEx is incredibly narrow. It's land, building, equipment, and machinery. Accounting, as we know, was designed for the old-time manufacturing company. If you bought land, you built a factory, produced goods and services, accountants are happy as hogs. This is the way the world is supposed to work. And in the old economy, 80% of companies were like that. Today you have service companies, technology companies, pharmaceutical companies. Accountants, quite honestly, have no idea what to do. They're completely confused. And we can't wait for them to get unconfused. We've got to do it for them before they get there. So we're going to talk about correcting for accounting mistakes and valuation and why it makes a difference. And already we talked about tax rates. So I'd like you to start thinking again about effective and marginal tax rates. And I've already given away some of the answers that they're different. And in fact, I'll give you the numbers. The average effective tax rate for US companies last year was about 27%. The marginal tax rate in the US is 40%. I've already given you one reason for the difference, right? If you have a lot of foreign income and you don't bring it back to the US, your effective tax rate can be much lower than the marginal tax rate because the US has the highest corporate tax rate in the world, 40%. The average in Europe is closer to 25 to 30%. So the more foreign income you have. But what else do you think explains why effective tax rates are lower than marginal tax rates? Of the 10 sectors that have the lowest effective tax rates, 5 are natural resource companies, oil companies, mining companies. You know what makes their effective tax rate so low? The US tax code is like a Christmas tree, filled with gifts to different sectors. And over time, there are all these tax credits that have been... So what you have, the other factor is, you have all these tax credits, you can end up with an effective tax rate that's lower than the marginal tax rates. The first is foreign income. The second is all these special clauses in the tax code. The third is, you have a lot of tax lawyers, right? And transfer pricers. Freaky little people. What's their job? To make it look like you made very little income this year and move your income either overseas or across time. And they're really good at doing this. And when you move your income across time, you lower your taxes today. Your effective tax rate is low, but you defer taxes till a future year. Those are the three forces: foreign income, special deals in the tax law, and tax deferral strategies that move your taxes into future periods. Today we're going to talk about what to do with all of those when you do cash flows, because that's what makes your effective tax rate lower than your marginal tax rate. So let me go back to what I was started with, and let's talk about the weights for the cost of capital. Anybody here doing the CFA? Nobody here doing the CFA, the CFA 1? Those of you familiar with the CFA, it's actually become a very popular certification program. I do that keynote every year. I don't have a CFA. I have no desire to have a CFA. I don't want to sniff a CFA. So basically, I don't even want to get close to a CFA. It's just too much work for me. I'm just too lazy. But it's become an endurance test. It's become an endurance test for the following reason. The CFA, to have value, everybody can't get through it, so they have to fail about 2/3 of the people who take the test. So I think hundreds of thousands of people, 2/3 have to fail. And it's also an open book, it's a closed book, closed notes exam, so it's become an endurance test. They give you 8,500 pages to read. And one of the questions is, what was on page 4,235? You don't know, you failed the test. And I don't think this is a great way of separating people who can do financial analysis from not. So every year I beg them, please let me write your exam. They'll never let me, but if they did, it'd be a one-question exam. And if you can answer the question, you get all 3 levels. You ready? This is an unofficial CFA exam. I'm going to ask you a question, and if you can answer this question, I will unofficially grant you a CFA 1, 2, 3. You can add it to your name. In fact, everybody has a CFA, that becomes an addendum to their name. Joe Smith CFA. Why? CFA. Okay, so basically, you're welcome to add it on, CFA 1, 2, and 3. So here's the question. Every single finance book, including my corporate finance book, my valuation book, when you get to the cost of capital, the rule for weights for debt and equity is very simple. You're supposed to use market value weights. Okay? Market price times share, number of shares for the equity, market capital, and market value of debt. Market value of equity and market value of debt. So here's my question as to why that rule is so rigid. Is it because the market is usually right? What if you gave me that answer? What's the hole you're digging for yourself? Let's say you told me, that's why I'm doing it, is because the market is usually right. You put in those market value weights, you come up with the cost of capital. What are you going to do with this cost of capital? You're going to discount the cash flows to the firm. You're going to come up with the value of the firm. You're going to subtract our debt. You're going to come up with the value and then tell me that this stock is mispriced, and I'm going to say, but you told me the market was right, so how can you, so don't go there, because this is the most dangerous hole you can dig for yourself. So it's not because the market is right. Is it because market values are easy to get? Relative to what? Book values? They're right there in the balance sheet. Shareholders' equity, debt, so it's not as if market value is more. In fact, you could argue market value can be more difficult if you have three classes of shares and one is not traded. Is it because book values of debt and equity are meaningless? That's why I don't use them. I'd love to say this because I don't think much of accountants. But it's not quite meaningless. I mean, it can be screwed up in lots of different ways. So what the hell is it? I mean, if I'm going to give you CFA 1, 2, and 3, I wouldn't have put the answer up there. So I want to know why we use market value weights for debt and equity to get cost of capital, and then use that cost of capital to value the company and end up with values for equity and debt that are different from the market. How the heck do we get away with this? Yes?
That's the rate at which they can borrow in the market.
Finish the story. So that's the rate at which they can borrow to get the debt. What about the equity? Why am I using market value?
Because that's...
Don't make it about they, make it about you. You're trying to buy the company. Make it about you. So every DCF is actually an attempt to buy the company. So why market value then?
If that's the market value, then that's what I'm going to look at to determine.
Exactly. It's a cost of transaction for me. So it's not my job to go tell the market, oh, Tesla, you know what? Your stock is 3 times what I think the value is. I will pay only 1/3. It's not going to work. If I go to the market to buy Tesla shares, guess what? I'm stuck paying the market price. The reason we use market values for weights is because that's what a transaction has to get done at today. That's how I can get away with this contradiction. I can have a value very different from the price, but that's not what I'm going to be offering up front. So it's actually a very, very tenuous basis, because we're arguing that every DCF is actually an acquisition valuation, and this is what you'd have to pay to buy the company. That does create a problem if you're trying to value Snap, right? Because if you're trying to value Snap today, before the offering price is set, there is no market value. So what do I do then? We'll talk about that when we get to private company valuation, because this is a generic problem when you value private companies. Public companies, you can see why market value rules. That's why you come up with the weights based on market value. So now let's bring it all together. Right? This is the page I've been leading towards for about 100 pages. Let's assume I want a cost of capital for Embraer, that Brazilian aerospace company, in 2004. So as I go through these numbers, kind of review back how we came up there. First, I'm going to do the cost of capital in US dollar terms. Why? It's a choice. I chose to value Embraer in US dollars, so my cost of capital is going to be in US dollars. I'll tell you in a minute how I would change it if I wanted to do everything in Brazilian reais. So I start with the risk-free rate in US dollars. In 2004, the T-bond rate, the US T-bond rate, was 4.29%. That becomes my risk-free rate. The beta that I use for Embraer, I know you probably don't remember, but it's the bottom-up beta based on the aerospace company, so I built up to a beta 1.07. So that's a beta for Embraer, reflecting the business they're in. The implied equity risk premium for the US in 2004 was about 4%. Today that number is 5.59%, but then it was 4% because my risk premium. The lambda for Embraer, because there had only one big emerging market, Brazil, to deal with, so I didn't do the weighted average. I could have done the weighted average if it were in multiple markets. The lambda was 0.27. That came from regressing Embraer's stock price against Brazil's, default spreads over time. So I'm getting a measure of, and that gives me a dollar cost of equity of 10.7%. That is my dollar cost of equity for Embraer. Their market cap on that day was $11.04 billion. Share price times number of shares. So I got a cost of equity and a value for equity. To get to the cost of debt, I start with the same risk-free rate, 4.29%, and add 2 default spreads. Somebody remind me again why I'm adding 2 default spreads for Embraer? One was for the company, the other is for the country, because in a sense they're exposed to both risks. And if I add those two, I come up with a dollar pre-tax cost of debt of 9.29%, net of the marginal tax rate in Brazil of 34%. That gives me an after-tax cost of debt of about 6%. The market value of debt is $2.083 billion. The weights based on those market values are 84% equity, 16% debt, my weighted average cost of capital in US dollar terms is 9.97%. Everything has a place in your cost of capital. The risk-free rate reflects your currency choice, your beta reflects the business you're in, your equity risk premium reflects where you do your business, the cost of debt reflects your default risk. It all comes together in the cost of capital. The one detail I want to kind of nail down is market value of equity is easy, share price times number of shares. Market value of debt can be a nightmare. Because even companies that have bonds outstanding have a substantial amount of bank loans that are not traded. So you know what most investment banks do when it comes to cost of capital? They use the market value of equity because it's easy to get. Then they get to the debt and they start waving their hands, and after a while they say, oh, it's too difficult to get, I'm going to use book value of debt. Don't do it. Because converting book value of debt to market value of debt is remarkably easy to do. Somebody remind me how we price a bond. What do we do to price a bond? Come on, at this stage in your life you should be able to do it. So I have a 10-year, 4% coupon bond. To get the price of the bond, what do? I project the coupons and the face value, and then I discount them back at today's market interest rate, right? So the market interest rate is 5%, and the present value that I get will be below 1,000 is usually the face value of a bond. So basically I discount the cash flows at today's market interest rate. I'm going to borrow that concept. To get the market value of debt for Embraer, here's what I did. I started with the book value of debt, which was 1.953 billion riyal. That came right off the balance sheet, book value of debt. I went to the income statement and discovered that their interest expense was 222 million. So at this stage, I have the book value of debt 1.95 billion. I have an interest expense of 222 million, and their debt had an average maturity of about 4 years. And you can usually get this from the footnotes. So I treated this as a gigantic coupon bond, with 222 million in coupons every year for the next 4 years, and at the end of the fourth year you got the 1,953 million, the book value as a face value. You discount them back at the 9.29%, which was my pre-tax cost of debt. I get a present value of 2.083 billion. I've converted in one step the book value of debt into market value of debt. Okay. Essentially then, you can see what's driving the difference is the difference between my book interest rate and my market interest rate. If my book interest rate is higher than my market interest rate, as it is for Embraer, my market value of debt will be higher than the book value of debt. If it's roughly equal, the two are going to be the same. And if the book interest rate is lower than the market interest rate, my market value of debt is going to be lower than my book value of debt. Lots of pieces, lots of little details. None of the details are complicated, but there are lots of them. So when you do cost of capital, kind of keep each item separate until you brought them all together. And the cost of capital in dollar terms for Embraer is 9.97%. So let's say it's 4 weeks into the semester. You computed a dollar cost of capital for Embraer. Took you a long time to get there. And you go to sleep, and next morning you wake up and say, you know what, I should be doing everything in nominal REI terms. It's a nightmare, right? Because all that work is now down the drain. Not quite, because converting a dollar cost of capital to nominal REI cost of capital is not difficult to do. And there are two ways I can do it here. One is I can take the numbers you saw on the previous page and replace my US dollar risk-free rate, which is 4.29%, with a nominal REI risk-free rate. Remember how we got risk-free rates in different currencies? And in 2004, that risk-free rate would have been 12%. That pushes up my cost of equity, pushes up my cost of debt, gives me a cost of capital that's going to be about 16%. There's an even easier way to convert a dollar cost of capital to any other currency. And this is a technique that will serve you well in the future because you're going to be working with different currencies. I have a 9.97% dollar cost of capital, right? Why do we say currencies matter? What's the key item that makes currencies matter? It's expected inflation, right? Let's suppose I told you that the expected inflation rate in Brazilian reais was 8%, and the inflation rate in US dollars was 2%. So in other words, the REI inflation rate is 6% higher. If you're in a hurry, here's what you can do. Take the 9.97% cost of capital, which is in dollar terms, add the extra 6%, the differential inflation, you've got a dollar cost of capital converted into a REI cost of capital. If you want to do it right, there's actually a compounding effect, which is what I built in here because it's actually inflation builds on inflation. So if you do that, you end up with a 16.44% REI cost of capital. In a couple of weeks, I'm supposed to go to Lagos, Nigeria to do a value. That's why I'm going to value a Nigerian company to throw into the mix. And I have to value a company in Nigeria in Naira. And then I built up to it, starting with the Naira risk-free rate. But that's, God only knows what that risk-free rate is because there's so much noise in the process. Nigeria is a B1 rated country. It's almost at junk bond status. So I did a Nigerian Naira. I didn't trust the numbers. So the way I did it to make sure that I was on the right track is I did the cost of capital for this Nigerian company in US dollars. Because there I know what the risk-free rate is, I built up to it. And then I made an estimate of expected inflation for the US was easy. It's about 2%. You can back it even out of the market. Made an assumption about expected inflation in Nigerian Naira to see what that number looked like, just to make sure that my local currency numbers were not giving me crazy numbers. So it's a good way to kind of keep your perspective as you move from currencies to think about a dollar number, because all your risk premiums and default spreads come from dollar-based markets. So you might actually be more comfortable working with dollar numbers until the last moment and then doing the differential inflation to convert your cost of capital into Pakistani rupees or Indonesian rupiah, Nigerian Naira, or Brazilian reais. So any questions on this technique of getting inflation? So basically the inflation I got for the US, the way I got it was I took the T-bond rate and subtracted out the TIPS rate. The TIPS rate is a real risk-free rate, the T-bond rate. So that was easy. For expected inflation in Nigeria, I can't trust the official number, right? So I went to the World Bank. The World Bank actually has estimates of expected inflation for countries, for 160 countries. Are they right? I have no idea. But you know what? As long as I use that same inflation in my cash flows, my discount rates, I'm going to be okay. So I'm not going to beat myself up about the number being wrong. Just pick an inflation number, build it in, and make sure you build that same inflation number into your cash flows. Final loose ends. I've acted like there are only two ways to raise money, debt and equity, right? And generically that's true. You can either borrow the money or you can use equity or your own money. However, there are companies, and some of your companies might have these securities which are part debt, part equity. They're called hybrids. I'll give you an example. You know what a convertible bond is? Somebody described to me how a convertible bond works. I buy a convertible bond, what do I get? I get coupons like a regular bond, but what's a convertible part? What am I allowed to convert it to? I can convert to equity. There's an equity option. A convertible bond is part debt, part equity. It's a hybrid. A preferred stock in the US. Preferred stock in the US is like debt in many ways because the dividend is fixed up front, unlike common stock. But it's not quite debt because it's not tax deductible. Another hybrid security. I absolutely detest preferred stock. It makes my life incredibly difficult. You know who the biggest issues of preferred stock are in the US? It's actually a very bad way of raising money because you pay debt-like rates, but you don't get the tax benefit. You think, why would they do it? The biggest issuers of preferred stock in the US are banks. And why do you think they issue preferred stock? It's such a bad way of raising capital. What is it that makes it attractive to banks? You know how banks are judged based on regulatory capital, having enough regulatory capital to survive? The regulatory capital authorities treat preferred stock like equity. So a bank feels it's getting the best of both worlds. It gets to borrow money, not add to its common share count, no dilution, but it gets treated as if it issued equity. Stupid reason to issue preferred stock. And thank God it's banks, because banks, I'm not going to do a cost of capital anyway. Everything's going to be equity focused. But if you have a company with a lot of preferred stock, my suggestion is you keep that as a third way of raising capital. You've got debt, you've got equity, you've got preferred stock. If it's not very much, just act like it's not even there. It's just not worth the trouble because it doesn't fit into either debt or equity. If you put into debt, you're going to give it a tax advantage it doesn't have. If you put into equity, you're putting it where it doesn't belong. It doesn't have a residual dividend. It's a fixed dividend. So preferred stock, there's not much you can do about it. But convertible debt, I think you can actually break out into debt and equity components. And I'll give you an example of how this would work. Let's assume you're looking at a company which has a $125 million convertible debt issue. That's the face value of the convertible debt. The coupon rate on the debt is 4%. So coupons are always based on the face value, 125 million. A 10-year maturity and a market value of 140 million. So basically, I've given you the face value of the convertible bond, the coupon rate on the convertible bond, the maturity, and the market value of the convertible bond. Let's assume that if this company went out and borrowed money in the regular bond market, its bond rating would be single A, and the interest rate it would have to pay on its debt is 8%. So here's how I'm going to break the convertible bond down. Take the convertible bond, act like you bought the bond, and act like the conversion option goes away tomorrow. So basically what are you stuck with? You're stuck with a regular straight bond, where the coupon every year is going to be 50 million, and the face value is going to be 125 million, and they're all going to get discounted back at the 8% discount rate because that's all you have is a standard bond. The value that I get when I take the present value is 91.45 million. Yeah. So if this bond had no conversion feature in it, it would trade at 91.45 million. What is it actually trading at? 140 million. Why are people willing to pay an extra 48.55 million? Because you get a conversion option, which is equity. I'm going to take the 48.55 million, treat it as equity, put the 91.45 million into debt. My hybrid problem has gone away. I'd like to have only two ways of raising capital. It makes my life more straightforward. It makes my choices more logical. So wherever I can, I'm going to remove hybrids from the mix. And with convertible debt, you can do it with preferred stock. Unfortunately, there is no easy way to do it. So this picture kind of captures everything we've talked about over the last few sessions. Cost of equity comes from looking at equity, bottom-up beta. Cost of debt reflects a rate at which you can borrow money today, which requires a default spread, which you can either get from a rating, an actual or a synthetic rating. Okay? And the tax rate you should be using should be a marginal tax rate because interest saves you tax as a margin. The weights should be market value weights. Market value of equity is easy. Market value of debt takes a little work. Okay? In a little while, I'm going to talk about what should be included in debt. But up till now, at least, I want the framework for cost of capital to be out there. So when we start talking about what to include in debt, you know where it's going. Any questions? So now let's move to cash flows. As I said, in accounting with a big focus on accounting earnings, bottom line, net income, earnings per share. In finance, the focus is always on cash flows. So let's set the structure up. I'm going to start off with a three-step process to get to cash flows. I'm going to start with those accounting earnings. Much as I curse accountants, that's where I go for my raw data. I open up the financial statements. I start with accounting earnings. Okay? If I'm looking at cash flows to equity, my measure of accounting earnings is going to be net income, income after interest expenses. If I'm looking at cash flow to the firm, a pre-debt cash flow, I'm going to look at operating income. So my measure of accounting earnings is different depending on which cash flow I'm trying to compute. From that current earnings, I subtract out what the company reinvests back into the business. In both short-term assets and long-term assets. What did it reinvest back in short-term assets? I capture with a change in working capital because I'm putting money back into the working capital. And long-term assets, I look at capital expenditures with a much broader definition of CapEx than what accountants would do. So I've got earnings minus reinvestment. And if I'm looking at cash flow to equity, if I have any debt payments to make, principal repayments to make, I've got to factor those out. So up front, you can already see I'm making you pick. Do you want to get cash flow to equity or cash flow to the firm? Because the pathway you adopt will be different for each one. So my plan is the following. I'm going to start with this big picture measure of what the cash flows are. Then I'm going to go through detail by detail because there are so many different ways in which you can trip up in trying to estimate cash flows. So if you ask me to value a business, there are three ways I can estimate cash flows. One is I can cheat and say, look, I don't know what the cash flow is. I'm just going to look at what they return to stockholders in the form of dividends. If I want to be expensive, dividends plus stock buybacks. So this is when you're desperate. You say, I don't know how to estimate cash flows. We focus on dividends and stock buybacks. If you can estimate cash flows, those cash flows can either be estimated to the entire business or to equity. And compare those two setups next to each other so you can see the contrast. When you start to get cash flow to equity, you start with net income, but when you look for cash flow to the firm, you start with operating income. And you can see why, because operating income is before interest expenses. I act like I pay taxes on that operating income. My starting point is after-tax operating income for cash flow to the firm, net income for cash flow to equity. The next two line items are the same for both. I subtract out what I reinvest back in the business in both long-term assets and short-term assets. Short-term assets, I look at the change in working capital. For what I'm reinvesting back into the business for long-term assets, I take the difference between capital expenditures and depreciation. Why the difference? I mean, CapEx is what I'm spending on plant. Why am I just not subtracting out CapEx? What is this netting out depreciation doing? When I compute net income and operating income, it's after depreciation expenses, right? Depreciation is an accounting expense. It's not a cash expense. What does that mean? You don't write a check to Mr. Depreciation. If you've been doing it for a while, I'm willing to change my name. I'm not that far off demoter and depreciation. I can collect lots of money. Depreciation is an accounting expense. So your earnings went down, but the money is still sitting in the bank, right? So here's what you're going to do. You're going to take that depreciation that's sitting in the bank and use it to cover some of your CapEx. It's what you have to invest over and above the depreciation. That's what you have to come up with. So when we look at this difference, it's called net CapEx. We're looking at what you have to put into long-term assets to increase your long-term assets. So net CapEx minus change in working capital. If I'm doing cash flow to the firm, I'm done. That's my free cash flow to the firm. If I'm doing cash flow to equity, I have one final item. When I borrow money, cash comes into the business. So think like the equity investor is sitting at the cash till, right? So you make net income, you do CapEx, that's money out, depreciation, money in, working capital goes up, money out. You borrow money, cash comes in. It's a cash inflow. I know it's very counterintuitive. You're borrowing, that's bad. You can have any judgment call you want to make about borrowing, but when you borrow money, cash comes into the business. When you repay debt, cash leaves the business. So that last line item you see for cash flow to equity looks at the net cash flow from debt. And that number can be a positive cash flow. If your debt went up during the year, it's a negative cash flow, the debt went down. Free cash flow to the firm, free cash flow to equity, dividends and stock buybacks. I'm going to start with free cash flow to the firm because that's a number more of you are going to be valuing the business than equity. I mean, I can predict that's going to happen. So I'm going to start with that. But then I'll mop up loose ends and talk about how to get from there to free cash flow to equity. One of my cautions as you go through this class is as you get closer and closer to the quiz, you'll start developing these formula sheets. And if you're not careful, you'll start to see hundreds of equations. Say, oh my God, there are so many equations. One reason there aren't that many equations is I'm just taking the same equation, presenting it lots of different ways. And I'll start with free cash flow to the firm to show you 3 different ways in which I can present free cash flow to the firm. They're exactly the same, but they're presented 3 different ways. The first is what I just showed you. You take after-tax operating income minus net capex minus change in working capital is free cash flow to the firm. The second, I could take this number inside the brackets and call it reinvestment. I'm consolidating the two. So when I talk about reinvestment, I'm talking about both net capex and change in working capital. And there's a third way I can present it, which is pure algebra. I can take this reinvestment, which is a dollar number, and convert it into a rate. So if your after-tax operating income is 100 million and your reinvestment is 30 million, I can say your reinvestment rate is 30%. Every single way, I get the same final answer. You're saying, why do you need 3? Because it's sometimes convenient for me to talk about in one way than the other. So as you look at free cash flow of the firm, ultimately what you're looking for is, what cash flows do I have left over after I make my tax payments and after reinvestment, but before debt payments? Now here's my first question to you. When you do free cash flow of the firm, see this EBIT times 1 minus tax rate? The tax rate you use there is the tax rate on the entire, so basically you act like you're taxed on your entire operating income. You see, what do you mean act like? Because you don't get taxed on operating income, you get to subtract out interest expenses, right? I'm asking you to ignore your interest expenses when you do your after-tax operating income. Why is that? Are the tax savings from interest expenses real savings? Yeah, they are. I'm asking, don't worry about them. Why am I asking you to ignore the tax savings from interest expenses when you compute your cash flows? What do I discount these cash flows at? Your cost of capital. What goes into a cost of capital? Cost of equity and a after-tax cost of debt. My tax benefits from debt are already in my cost of capital. If I also count the same cash tax savings as a cash flow, I'm double counting. You know that 1 in 4 DCFs that I see make this mistake of double counting. So be very careful when you do your after-tax operating income. Act like you have no interest expenses. You're not being blind. You're saying that gets taken care of in my cost of capital. I shouldn't also be counting it when I do my cash flows. So I'm going to go through a series of tests I run. When I sit down to value a company, of course I open up the 10K or the 10Q or both. So last week when I sat down to value Apple, I wanted to value Apple. So I pulled up the last 10K. Unfortunately for me, Apple's fiscal year ends in September. So the last 10K came out in November. You're saying, why unfortunate? Because if I valued Amazon today, the last 10K just came out, so I can just take the 10K and run with it. Same thing with Netflix or Google or many other companies. But Apple is a September 10K. To value Apple, though, I need to go beyond the 10K. Not only do I need to update the number, but I need to fix all those accounting mistakes I talked about. So I'm going to take you through the process. And this is it's not a difficult process, but it's a process I do almost every company to make sure that I'm building off a good base. So here's the first thing that I'm going to do. I want to make sure that the number I'm using is the most updated number I can use for this company. So I'll talk about Apple and what I had to do for that. Second, if this company has earnings that go up and down and up and down, I have to be careful about using last year's number. It's common sense again. If I take an oil company and I build my entire valuation of the 2016 number, I might get a very different value than the value I should be getting because oil prices go up and down and I'm missing that. So when we talk about normalizing, I'm talking about taking care of the volatility of earnings over time. And finally, I want to clean up after the accountants. I'm going to talk about 2 items I routinely clean up for with every company and why I do it. One is leases, which I think should really be treated as debt. And the other is items like R&D, which should really be treated as CapEx. So I'm going to start with lease expenses first. Somebody who's good at accounting, remind me again how leases work in the US. There are 2 kinds of leases in the US. What are they called? Operating leases and capital leases. And what do accountants do with capital leases? They treat it as debt. It shows up on your balance sheet already. So you don't have to worry about capital leases. They've done the right thing. But if you have operating leases, accountants go crazy. The operating lease expense shows up as an operating expense. And then there's a footnote that gets shown that tells you how much this company has as lease commitments in year 1, year 2, year 3, year 4, year 5. It makes absolutely no sense. Because here's the way I think about debt. Debt to me carries 3 characteristics. First, there's a contractual commitment that you've made to make payments, right? Unlike equity, where you issue equity and say, I'll pay dividends if I can, with debt you make a contractual commitment to make interest payments. Second, that payment is usually tax deductible in the US. And third, if you fail to make that payment, bad things happen to you. You go bankrupt, your knees get broken, whatever it is. Fixed payment, tax deductible, loss of control, that's my definition of debt. So when I look at a balance sheet, these items automatically become part of my debt. Any bank loans, obviously debt. Corporate bonds, obviously debt. Short-term bank loans, long-term bank, any interest-bearing debt is obviously debt. So I count that as debt. What about accounts payable and supplier credit? What do they lack? I don't treat them as debt, so obviously they must be missing one of these criteria. What's missing in accounts payable and supplier credit? Yeah. An explicit interest payment, right? Why do I say explicit? What happens when you use supplier credit? So the supplier sells you stuff. He says, you can pay me right away, you can wait 60 days. He's not stupid, right? To get you to pay right away, what does he offer you? Usually a discount. So there is an implicit payment, but because it's implicit, you don't get to observe it. So the reason we don't treat accounts payable, supplier credit. So when you do total debt, go down the balance sheet looking for interest-bearing debt, which will be short-term debt in the current liability, short-term portion of long-term debt, and long-term debt. But don't stop there. And here's why. Let's say you decide to lease a store in Short Hills Mall. I live close to Short Hills Mall, one of the most expensive malls in the country. You sign a 10-year lease. Typical store there, a lease payment each year is probably going to cost you $4 to $5 million a year. So basically, let's say you've got this prime spot, you've signed the lease contract, agreeing to do what? Pay $5 million a year for the next 10 years. Is it a contractual commitment? You just signed the damn contract. Of course it's a contractual commitment. Is it tax deductible? Yeah, because it becomes part of lease expenses. And what happens if you fail to make a lease payment? They throw you out of the mall. And if you fail on a bunch of lease payments at the same time, you go bankrupt. That's what happened to both Caldor and Bradley's, two discount retailers in the US, is they failed to make enough lease payments, were pushed into bankruptcy. While their accountant said, they have no debt, they have no debt, they were going bankrupt. How the hell do you go bankrupt with no debt? It's because you misclassified the biggest debt item, which is leases. So to me, this seems like a no-brainer. If you use leases, I don't care what the accountant calls it, you're effectively borrowing money. So I want to go fix leases, treat them as debt, and I want to fix R&D. But before I do that, let me nail down this updating thing. With Apple, I had one 10K, but it ended in September. I had one 10Q that came out last week. The 10Q actually contained good news as good news goes by Apple. Their revenues actually grew by 3%. You think that's good news? Well, the revenues in the last quarter actually declined. So this was actually good news. That's why the stock is up to 133. But if I stayed with the September 30th report, I'm using old data. So with US companies, I always try to use those trailing 12-month numbers, which means I take the last 10K, I take the last 10Q. And one of the things that 10Qs give you that will help you is they give you what the company did in the case of Apple in the first quarter of 2016-17, but they also give you the first quarter from the previous year. You see what the math is? You have a 10K, you have the first quarter of the new year, the first quarter of the last year. To get to a trailing 12-month, all I need to do is take the 10K, add the new first quarter, and subtract out the first quarter from the previous year. That's why I said all you need is one 10K and one 10Q to get to a trailing 12-month number. Did it make a difference for Apple? Yes. My value would probably been about $5 less per share than I got if I'd stayed with the September numbers. You see, only $5, who cares? If this were Twitter or GoPro, the difference can be immense because one quarter can make an immense difference. So don't blow it off. If you can get trailing 12-month data, use that trailing 12-month data. Many of you might get lucky. You have a calendar year end. You might be able to coast unless your company releases its 2017 first quarter, the May 3rd or something, 5 days before your project comes due. But for the moment, you might be okay. But you want the most updated number you can get. In Nigeria, I ran into a bit of a problem. I picked this Nigerian company. There's no SEC you can go to get the data. I was afraid to call anybody because I was afraid I'd get charged for things I wasn't getting. I went to their company's website, because usually you can get annual reports. And the last annual report they had was from 2015. There's no 10Q, there's no updating. I can value the company using 2015 numbers, but I know 2016 was a big year in Nigeria in terms of political risk, exchange rate risk. So I started looking through the news stories with the name of the company, looking to see whether I could get dribs and drabs of information. So there was a report from September saying that the company had reported that revenues were down roughly 4% in the first half of the year. I used what I could take. You're saying that's rumors. You know what? I'd rather take a rumored updated number than a really old number that's nailed down in the accounting statements. So in the US, I don't have to do that, but sometimes you might have to fill in pieces that you don't have to get the most updated numbers you can. So now let's talk about cleaning up for accountants. So I'm going to start with lease expense and argue that it's really a financial expense, and it's going to create a whole host of corrections I have to make. Then I'm going to move to R&D and argue it's really a capital expense, which is going to create a whole host of other corrections I've got to make. But I think we need to get these expenses in the right boxes if we really want to get an estimate of what the company is actually making, what it's generating as a return. In other words, to value this company right. So let's start with leases. What kinds of companies do you think have the most burden in terms of operating leases? I've kind of given you a clue. Retail obviously is one. What else? Airlines, but airlines actually depends because airlines, the lease commitment is so large that often it's treated as a capital lease. So some airlines it is and some airlines it's not. But that's a good point. Many airlines lease their aircraft, and if you structure your lease cleverly enough, it might not show up in your balance sheet. But in many airlines it is a capital lease. Restaurants, Applebee's, you write about it, lots of leases. Okay? In fact, here's a very, very quick measure of how big an impact this has in different companies. So what I did was I took the operating lease expense as a percentage of operating income, just to see how big it was. And across the entire market, operating lease expenses are about 12% of operating income, so it's not a small items. But in sectors like retail and restaurants, it can be 25, 30, 50% of your operating income. So when you correct for leases, you're going to have a huge impact in how profitable you think this company is. So it's not a small item, and I do this for every company, but if you don't want to do this for every company, at least if you're doing Macy's or you're doing some retail company, do it for those companies, because without doing it, you're not going to be able to get a sense of what's driving the value of the company. So let me set up this process. To convert leases to debt, if it's operating leases, you have to use the same way you compute the market value of debt. So to compute the market value of debt, what do? You take the interest expense and the face value, you discount them back at the pre-tax cost of debt, right? I'm going to use exactly the same technique. I'm going to take your lease commitments that you've given me. Remember that table that every US company has to do, and I'm going to discount those lease commitments back to today using the pre-tax cost of debt as my discount rate. What I get as a present value will be the debt value of leases. So let's say I get $1 billion. Present value of lease commitments. I go and put it on a balance sheet as debt. I have a problem. You know what the problem is? The balance sheet has to balance. So when I put $1 billion in debt, what do I have to create on the other side to make the balance sheet balance? I have to create a counter asset. I'm going to call it leased assets with $1 billion. Now once I create an asset, what do I have to do in the subsequent periods? To depreciate it. This is like give a mouse a cookie time, right? You invite the mouse in, next thing you want, have you read that book? Do read it. No. Wants a glass of milk, then he wants a bath, and then by the time you're done, he's taken over your house. It's not just adding back the lease expense, you got to go the entire distance. So you're going to convert the leases to debt, you're going to depreciate that lease, and you're going to adjust your operating income now for the fact that your operating income as originally stated was wrong because the accountant subtracted out lease expense. You're going to add back the lease expense, and you're now going to subtract out the depreciation you have had. In fact, there's a shortcut that you can use, which I sometimes use when I'm in a hurry, where I take the stated operating income, and to adjust it, I take the pre-tax cost of debt, and I take the present value of leases, which is my debt value, and say my interest expense last year would have been, and add that on to get an adjusted operating income. So in the abstract, this is kind of tough to deal with, so I'm going to take an example. So about 10 years ago, the Gap invited me to come to their San Bruno office to talk to them about, because there was already talk in the air about how accounting rules were going to change to convert leases to debt. That was in 2003. It's supposed to happen in 2019, which tells you something about the lead lag time between accountants talking about getting things done and actually getting things done. So they said, can you come in and take us through what will happen to the Gap as a company in valuation if we change the rules, if we treated operating leases as debt? I said, not a problem. So if you look at the Gap in 2003, their conventional debt, their interest-bearing debt was about $1.97 billion. So in the balance sheet, it said debt of $1.97 billion. This is long-term debt, bank loans, etc. They had lease payments of $978 million just in 2003. And they gave me commitments, so this is right off the footnote. Remember, these are not expected lease payments. These are actual contractual commitments they've entered into of $899, $846, $738, $5. So basically, these are the lease commitments for the next 5 years. Beyond the fifth year, U.S. companies no longer have to break out the lease commitment. They just have to give a lump sum. And the lump sum that the Gap gave was $1,900 and something. I broke it out into 2 years because I don't think they're going to pay that entire amount in 1 year. Those are my lease commitments. My pre-tax cost of debt was 6% for the Gap based on their rating. I discount the lease commitments back to today at 6%. What I get as a present value, if I add up all of those present values, is $4.4 billion. So if I look at the balance sheet, it looks like they have about $2 billion in debt. But once I capitalize leases, their debt jumps to about $6.4 billion. What happens to their operating income? Their stated operating income was $1.97 billion, but if I clean up for leases, here's what happens. I'm sorry, $1.012 billion. If I clean up for leases, I add back the lease expense, $978 million, this year's payment, minus the 4.4 billion divided by 7. You're saying, why divided by 7? We have to depreciate the leased asset. I wasn't going to do sum of the year digits or double declining balance. I use straight line depreciation over the life of the lease, 7-year life. So that's my depreciation. My adjusted operating income goes to 1.36 billion. At this stage, they were completely confused. What does this even mean? So I took them through each layer of the valuation to show them how leases would affect that number. And I have to tell you, even before I show you the numbers, that they went through stages of delirium as we went through. Initially, they were incredibly happy about what I was telling them, and then they crashed and burned. So here's how it played out. I said, so basically the way to read this is what the conventional accounting for the GAAP looks like. This is what their numbers would look like if I capitalize leases. I said, let me start you with the good news. If I look at your income statement today, it looks like you make 1.012 billion in earnings. But if I capitalize leases, it actually looks like you make more money, 1.36 billion. So that's adding back the lease. So they were pretty happy. This is good, right? More earnings. I said, if you go to the balance sheet, right now all you're showing me on the balance sheet is the 1.97 billion in debt. But if you capitalize leases, the debt will jump to 6.4 billion. They were a little wary at this stage. That's bad, right? And I said, no, that's good. Because when I do your cost of capital, your existing cost of capital, if I use just the conventional debt, I get a cost of capital of 7.31%. But if I give you the leases as debt, your cost of capital drops to 6.25%. At this stage, everything seemed to be working in their favor. Earnings are increasing, cost of capital is decreasing. What's to complain about? And then I hit them at the final number. When we look at companies, we look at how well they invest your money, right? So how much are they making as a return on their projects relative to their cost of capital? If I trust the accounting numbers for the GAAP, they make 1.012 billion as income. Their book value of equity was 3.13 billion. It's one of the few places in valuation where we use book value. And their book value of debt is a conventional debt of 1.97 billion. It looks like they generate 12.9% as a return on capital with the conventional accounting. But if I capitalize leases and make it part of my invested capital, my return on capital drops to 9.3%. At this stage, they were completely confused. They said, our earnings are higher, our cost of capital go down, but our return on capital also goes down. What will happen to our value if we make? Is there a way you can answer that question without having to go through the full valuation? I took them through the full valuation. But is there a way to actually get a preview of what you're going to find? What's the value that they're creating right now? One way to think about value created is what you earn as a return relative to your cost of capital. If I trust my existing numbers, it looks like they're generating about a 5.59% excess return over and above their cost of capital. 12.9% minus 7.31%, right? After I capitalize the leases, when I ask you the same question, it looks like the spread they're generating is about 3.05%. My value for the GAAP dropped about 10% when I capitalized leases. And it dropped because I had a less favorable view of the GAAP after I capitalized the leases. They don't look like they're as good a company as I thought they were before they capitalized the leases. And the scariest companies, the companies that look really good before you capitalize the leases, then actually look like they earn less than their cost of capital after they... Starbucks in 2007 and 2008 had this issue. They looked really good on a conventional accounting basis. But if you think about Starbucks and how many there are, and I think just in New York there have 186 Starbucks. You think about those lease commitments building up. Once you capitalized all those leases, it looked like they were actually earning less than the cost of capital. The whole thing started to blow up. And that's why we capitalize leases. It's not because we're finicky about what to call debt, but because we care about what you generate as returns on your projects relative to your cost of capital. And to get a clearer sense of that with these companies, you have to capitalize leases. You might as well get ahead of the game. In 2019, as I said, all companies will have to capitalize all leases. It's coming, finally. But don't wait for it to come. You can do it ahead of time. Any questions on lease commitments? In my corporate finance class, I just half-jokingly said it's not just leases. Any time you have a big contractual commitment. And I talk about 2009, taking my kids to the Yankee game for opening day and thinking about debt and equity while I was sitting there watching the Yankees run out. You're saying, this is sick. Your opening day, you're watching the Yankees run out. Because here's what I saw. I saw a guy called Mark Teixeira run to first base. And what I saw was $27 million a year for 6 years. That's all I saw. So basically you go around I went around the infield and I took, at that stage was Teixeira in first, your cheap infielder was Robinson Cano at second, you had Mark Jeter, I'm calling Mark Jeter now, Derek Jeter at shortstop with another $20 million for 3 years, and of course there was supposed to be a guy called A-Rod on third base, but he was injured that day, but that was $27.5 million for 10 years. And on the mound was CC Sabathia, another $25 million a year for 6 years. I actually went home after the game and I took the present value of the infield commitments that the Yankees had and came up with $650 million. If you're valuing the Yankees, that's debt you've taken on. You might not call it debt, but those are contractual commitments. So this is not just about leases, it's about entering into any kind of contractual commitment that binds you down. Let's talk about R&D. Again, it varies across sectors. Across the market, it's about 10%, but if you look at technology companies, it could be 30, 40, 50%. Oil companies, what are oil companies doing? It's actually not called R&D in oil companies. It's called something else. Do you know what it's called in oil companies? What's the analogous expense to R&D? It's called exploration costs. So basically, in every oil company, you see this big line item. And let's face it, if you're ExxonMobil, you're not doing exploration expecting benefits this year, it's benefits down the road. It's just like R&D. Again, the rationale for treating R&D as a capital expense to me seems like a no-brainer. And maybe it's just me. But when I look at R&D, I see super capital expenditure. In fact, about 2 years ago, I was at the AICPA conference giving a keynote talk it was in Vegas. Don't ask me why accountants put their conferences in Vegas, because the exact opposite of where you think about logical, rational thinking. So, but they have the biggest rooms, I guess. So in a room with 1,200 accountants, which is as close to hell as I think I can get. Okay? But I said, what are they going to do, gang audit me? So basically I said, okay, I can say whatever I want. You know? So, and this was one, so my presentation was 10 things that accountants do that I don't quite understand. And this is one of the things I brought up. What do you guys do with R&D? This is the ultimate CapEx, because you taught me in my first accounting class that if I get benefits over many years, it should be CapEx. Why are you expensing R&D? And they came up with every conceivable rationale. But why do you think accountants expense R&D? What's the rationale they give you? I'm sorry? It's in the rules. But who writes the rules? They wrote the rules, so they can't hide behind the rules. So why do they write the rules of treating R&D as?
Because R&D is uncertain.
Exactly. They said the benefits are too uncertain. And I counted saying, look, if I built a factory in Kazakhstan, would you let me expense it? Borat could come in and burn it down tomorrow. All kinds of bad things can happen. When I build a regular factory, you don't let me use this line. How come just with R&D you're talking about? I mean, if HP builds a tablet factory, not pills, but no. Remember the last HP tablet kind of crashed and burned. It's the most uncertain investment of all. Uncertainty is not a dividing line you use elsewhere. Why just for R&D? They used every conceivable reason. Every single one of them made no sense. There is no good reason for this. It's just that they don't know what to do with R&D. So let's face it, you have to capitalize R&D. You've got to fix an accounting mistake. So I'm going to take you through the process of capitalizing R&D, and it's a 3-step process. So you're a company, you do a lot of R&D. The first question I'm going to ask you is, on average, how long does it take between the time you do R&D and a commercial benefit comes out of the R&D? See how I threw the on average? I know some of the R&D might not pay off. Some might pay off in 3, some might pay off in 5 years, some in 7 years. Just give me an average number. Let's say it's 5 years. I go back and collect the R&D expense every year for the last 5 years. You say, why for the last 5 years? Because if I've been capitalizing R&D all the way through and you have a 5-year life, what should I be doing? I should be writing it out over 5 years, right? I should take the R&D. So basically what I'm going to do is I'm going to act like I've been capitalizing R&D right from the beginning, and I'm going to take the R&D expense and write off 1/5 each year. And I'm going to keep track of 2 numbers. How much R&D I'm amortizing or writing off this year, and how much is left over as unamortized R&D. And each of those numbers is going to play a role in my valuation. So let's take an example. This is SAP. Familiar with SAP? It's a German software company. It's a very un-German German company. Okay? It's not rigid, it's very flexible, so basically it's a company, it's pretty good reputation in the technology business. I assumed a 5-year life. Generally, here's what I use. I use 3, 5, or 10. 3 for companies like Apple, where the R&D has to pay off pretty quickly. 5 for companies which have more application business software. 10 for pharmaceutical companies because they have to go through the FDA approval process. Don't, again, overthink this. Okay? 3, 5, or 10. So here I'm going to go with 5. I collected the R&D expenses from the last 5 years. So 5 years ago, their R&D expense was $744.67 million. And what am I going to do with that expense? I'm going to write off 1/5 each year, right? So I've written off 1/5, 5, 4. So basically, by the time I get to this year, this is my last 1/5 being written off, 148.93, 1/5 of that. There's nothing left over. R&D from 4 years ago was 969.38. I'm writing off 1/5. There's 1/5 left over. R&D from 3 years ago, I'm writing off 1/5. So each year, I take the expense, I write off 1/5 this year, and I see what's left over. What you see in the last column added up is $903 million. That becomes my amortization of R&D. So if I'd been capitalizing R&D, you'd have seen the equivalent, like depreciation this year, amortization of past R&D. The sum total of the second to last column is $2.9 billion. That's the R&D investment I've made that I haven't written off yet. That's now going to go to my balance sheet as an asset. It's a balance sheet still, right? So if I bring in $2.9 billion in assets, something has to change on the other side. Only two items, debt or equity. Which one am I going to put the $2.9 billion in? Where did the money for the R&D come from? It came from equity earnings. So it came from whatever was left over after debt payments. So my book equity is going to increase by $2.9 billion. So I'm going to close with a page that looks just like the GAAP page so you can see the effects of capitalizing R&D. So what you see again in the first column is what my numbers look like for SAP with conventional accounting. What you see in the second column is what those numbers will look like if R&D were capitalized. So let me again start with the good news. The good news is when I capitalize R&D for SAP, the earnings go up. Why? Because I add back the R&D expense now and I subtract out the depreciation. It increases by about $117 million. And that's going to happen with any company with growing R&D. You're going to see the income go up. When I go to the balance sheet, the book value of equity, which is $3.8 billion, will now jump to $6.8 billion. Basically, I'm bringing in the value of the R&D as an asset. But here's the biggest change, and this is why we do it. Okay? Your cash flow actually is exactly the same, whether you capitalize R&D or not, because you're writing out the check, whether it's a capital expense or who cares. It's still money out. But the big change is my return on capital for the company. With the old approach, I get a return on capital of about 27%. SAP looks like an amazing company. But when I capitalize that same the R&D, the return on capital drops to 17%. Still a very good return on capital, but once I brought the R&D onto the books, the company looks less attractive than it did before I capitalized R&D. This is an issue you're going to run into with a Google, an Amazon, a Facebook, an Apple, because your biggest asset is not on your books, and if your biggest asset is not on your books, you're going to overstate your return on capital and return on equity. Your company is going to look a lot better than it really is because you're not being realistic about what its true capital expenditures are. So I have a suggestion for you. I hope you pick your company. I hope you have an annual report at the minimum. Okay? If you got a quarterly, that's fine too. Go into your annual report and look through the footnotes. My suggestion is don't actually print out your annual report. It's a waste of money and time. Actually keep it as a PDF file. If you have a PDF file, you can search, right? So search for rental commitments or lease commitments. You'll see a table, if your company has them, which lists out the commitments. And this is happening globally, so you can get it. One final question. Have you been able to get on S&P Capital IQ yet? You've been able to? Okay, your access to S&P Capital IQ is now open. Try it out. It's an incredibly powerful database. And I'll send some suggestions on how to get there, but that has the lease commitments, so you can start to look for those numbers online.
I have a couple of questions. Like when I'm valuing a US company and for the ERP part, should I just use the ERP for the S&P or just all I need to add the yeah, it's operating mainly in America and partly in Europe. So I need to yeah, in many countries So I need to add the culture. Okay, yeah, I mean, yeah, but when I see the like revenue breakdown, there's also a section for the like all other areas. But how do I? Yeah, okay.
So I have two questions. First is about challenge. Weekly challenge. What is the numbers here, like these numbers? Is that the answer, or did I not understand the answer? But like, for example, where is this book? Isn't the regression? You check the Excel function. There's regressions right there. Oh, that. Oh, okay. So it's like a regression like function, and then you. All I'm saying is one that's regression can Excel regression. Basically, so we are not supposed to be calculating it from the regression. Take the regression and that regression give you the okay, got it. So second thing is about I actually calculate a lot of stuff, but I have a few questions. First of all, like beta is not time sensitive, right? Like it's okay not to be up to date. Like bringing it up to date. And then this company, it's beta is not the company's business is to change. Not somebody and then for this company, it's an auto company in Hong Kong, listed in Hong Kong. That's capture ratio. It's 0.1, but its average of the peers is like 0.3. Is that? It's like 10% of the capital. And then cost of debt, like so. What's the difference between calculating from the average of the I can't do it. Oh, that's a book. And so I need. So do I need the Bible or something like that? Start with the whisper. And then add added the post.
Hello, sir. I emailed you over the weekend. Omar.
Yeah, send us
Because I had one and then didn't work out.
Professor, so based on today's lecture, when we're calculating the cost of capital, we need to calculate these adjustments before we actually calculate the cost of capital number.
not R&D one. R&D.
Oh, right. But the leases would definitely. Okay, thank you.
Professor. So what if I want to value a biotech company? So if I project the future earnings, have I to like separately project every pipeline drugs?
No, you can't do that. You can't do the portfolio. It's got to be.
Okay. So what kind of like future earnings projection should I use? Just assume
I did. I'd be doing evaluation. That's your job, evaluation. You look at what they have in their portfolio. You look at what's in their pipeline.
yes.
Make the same judgment. Anybody investing in general, you use it to come up with a consolidated number. Hi, how are you?
That's how are you? Good. I'm gonna do Yelp as my company, and they have 2% of their revenues come internationally. It's like 2.44. Is it?
There's a rest of what 7.06% or something, which is everybody but the US. It's not like anybody.
Okay, awesome. Thank you.
Hi, Professor. I'm doing Delta Airlines as my company, and they're reporting in their international revenue. They report it from a continent perspective, so it's Atlantic.
Atlantic? What?
They say like Atlantic, Pacific, and Latin
They do it
America.
by ocean, not by continent?
Well, yeah, they do it by ocean. So in their presentation, I cannot find a country or even
There's
continent.
nothing in the ocean, right? So what's in
Yeah.
there? Atlantic?
So Atlantic includes Europe. So they have domestic, which is U.S.,
Yeah.
and then small portions Atlantic, which includes Europe and Africa. And then, so from a country risk premium,
So you'd have to use the weighted average.
weighted average of the whole, since I don't know,
Weighted average because you know the GDP of Europe. Mostly Europe. It's not Africa.
mostly Europe, and then for
If you look at
Pacific,
the GDP of Europe,
Right.
it's 50 times the size of Africa. So you're Europe and Africa in one group.